Opinions expressed herein are subject to change and not necessarily the opinion of the firm. Past performance is no guarantee of future results. The information presented herein is for informational purposes only and is not intended to provide personal investment advice. It is important that you consider your tolerance for risk and investment goals when making investment decisions. Investing in securities does involve risk and the potential of losing money. The material does not constitute research, investment advice, or trade recommendations.
And now introducing Mr. Keith Lanton.
Okay, good morning. Hope everyone's doing well. Hope everyone's healthy, most importantly, and everybody's loved ones are healthy. So, where are we this morning? Well, where we started this morning at about 7:15 when I got into the office is very different than where we are right now. We had action taken by the Federal Reserve, which is supporting the markets, both the equity and the bond markets, and we'll talk about that in a few minutes. Full of anxiety and watching the news, and if you are consistently watching the news and observing what's taking place in the media, you will certainly be anxious, you will certainly be concerned about your investments, and you'll almost certainly want to take some sort of action to make that anxiety go away. And that is one of the roles that we fulfill, is we are a buffer between investors and the markets. Doesn't mean that there should be no action taken, but we are a buffer so that automatic trigger is not just pushed and the button doesn't just go off because someone wants to make something go away or they want to feel better by doing something. And that is where an advisor, a trusted confidant, adds immeasurable value over the lifetime of an investor's relationship. And these are the times when advisors shine and have the potential to add tremendous value to their clients and clientele. So when talking to your clients about staying calm, or if you are an investor, how do you stay calm during these emotional times? Number one is you've got to remember that the feeling is an emotional reaction that can sometimes lead someone to sell their good investments. In fact, perhaps one of the most common emotions or reactions to weakness is to sell what's been doing best. And that is in order to make oneself feel better. It's in order to make oneself feel like I've raised some cash, I'm okay, and perhaps that's justified. But very often, what is sold is often the best investment because the investor doesn't want to take too much of a loss, and they sell perfectly good investments, and they may hold on to some of the investments that are more challenged. So you might feel a little better by selling with the crowd, but inevitably an investor will come potentially to regret the bad news several months down the road that they got chased out of good stocks. And when speaking to clients, or if you're an investor, think about what would the world's greatest endowments do? They're running massive amounts of money for public retirement funds and big stakes. Are they panic selling because of the coronavirus? By and large, big public pension funds have said that they are not selling. In fact, several of them have said that they are buying stocks selectively as they fall. And this is why you need to remain calm and focused and act like the professionals. Keep in mind, over long periods of time, stocks shrug off even the worst of news. The global economy has recovered from calamities. World War II, where people were on rations. I was talking to my father-in-law just to give some perspective to my kids last night over dinner. And he was explaining how you had to have a ration card to go out and get bread, milk, eggs, how you had to have emergency drills with wardens to make sure that your lights were out, to make sure that the searchlights were able to search for enemy planes. These were circumstances that people were living with during World War II. And yet America rose to go on to even greater heights despite those setbacks. We had, of course, the Great Recession, and despite all of these setbacks in 5-year rolling periods, since 1950, stocks and bonds have always had positive returns over 5-year rolling periods. Also, remind investors, or if you're an investor, focus on when do you need the money. If you're 50 and worried about your IRA or 401k, remember you can't withdraw the money without paying taxes and a penalty until you're 60. Now there's some provisions going on right now that may make exceptions to that, but in general it's still a good idea, unless there's an emergency, to keep those funds invested until you're retired. Do you really think if you're 50 years old in 10 years, your IRA will be worth less than it is today? Invested properly, your money at a 6% compounded rate will double in 12 years. Unless you're retired and need income now, cash is an automatic loser as an investment. Not only is inflation eating away at your money, it's virtually impossible for cash to compound in a bank account, paying nearly nothing in interest. If you are retired, how much do you use of your portfolio for cash flow? If you're living off your retirement right now, what percentage of your entire portfolio are you spending each year? If it's 3, 4, or even 5%, it's likely that given the current situation that your dividends alone will cover your needs and you'll be able to ride out the current situation. Forget your gut instincts. Your gut instincts were something that you had embedded in you in different times. In other words, when we were prey and we needed to get out of the way immediately. That's what our gut is designed to tell us. A lion is coming. We need to cut and run. That's how we survived. That's not necessarily how you survive a financial crisis that we are in currently right now. Also, keep in mind, Bert Malkiel, who wrote The Random Walk Down Wall Street, Princeton professor, he points out that most people who choose to get out, so if you say, I'm out, I'm going to time my way back in. Bert Malkiel points out those of us who choose to get out rarely get back in time and miss the big moves up. He put it this way. He says, I've been around this business for 50 years, and I've never known anyone who could time the market. And I've never known anyone who knows anyone who could time the market. You can't do it. It just is something that investors historically have not been able to do. Also, keep in mind, if you have that regret, well, I should have sold it high, I should have sold at the peak. I'm having lots of remorse. I knew it. I knew the market was going to go down. I knew February was the peak. I'm sure some of you have felt that way or spoken to people who felt that way. Remind yourself that even if you were that brilliant and you had sold at that top, if you had your assets in a taxable account and you were in a state like New York or California, well, 35% to 40% of those gains would have been paid in taxes, and you would be roughly at the same net worth that you are today in today's current market environment with the market down about 35%. So you wouldn't have been in a very different position that you're in right now. Finally, keep in mind, and this is something to remember over and over and over again, if there is one magic genie out there, and we all wish we had a magic genie, it is to rebalance your portfolio. Over the course of time, if you automatically and systematically rebalance your portfolio, whether it's quarterly, semi-annually, annually, you will automatically sell out of what's appreciated and buy more of what's gone down. And if you had done that at the end of 2019, you would have sold some stocks and you would have bought some bonds. You'd be in a better position if you had done that. So whether you're doing it yourself or working with a financial advisor, and most people need to do this with a financial advisor because they don't have the discipline. The end of 2019, most people said to themselves, I feel great. Why would I sell my stocks? Bonds are yielding 2%, and stocks, I read in so many financial publications are going higher and higher, and why would I want to possibly own a bond and get 2%? Well, again, if you were automatically set up to systematically rebalance, or you work with a financial professional, you would have rebalanced your portfolio, and you'd be feeling a lot better today. So, those are some things about what investors can do to stay calm. What do successful people do to stay calm? How do they manage their emotions under times of stress? And the ability to manage your emotions and remain calm under pressure has a direct link to your performance. 90% of top performers in whatever field they're in, whether it's professional athletes, professional investors, professional CEOs, professional politicians, they remain calm. 90% remain calm and are skilled at managing their emotions in times of stress in order to remain calm and control. The tricky thing about stress is it's an absolutely necessary emotion. I talked about this a few minutes ago. Our brains are wired such that it's difficult to take action unless we feel, at least at some level, an emotional state. In fact, performance peaks under heightened activation that comes with moderate levels of stress. As long as the stress isn't prolonged, it's harmless. Intermittent stress events are probably what keeps the brain more alert and helps you perform better when you are alert. For animals, intermittent stress is the bulk of what they experience in the form of physical threats in their immediate environment. Again, long ago, this was the case for humans, and as the humans evolved, they're no longer in a situation where our day-to-day interaction with nature is that a lion is chasing us. The bulk of our stress now is subjective and under our control. Top performers have well-honed coping strategies that they employ under stressful circumstances that lowers their stress level regardless of what's happening in their environment, ensuring that the stress they experience is intermittent and not prolonged. How do they do that? One, they appreciate what they have. Taking time to contemplate what you're grateful for isn't merely the right thing to do. It improves mood, and it reduces the stress hormone cortisol by 23%. Number two, they avoid asking what if. What if statements throw fuel on the stress and worry. Things can go in a million different directions, and the more time you spend worrying about the possibilities, the less time you'll spend focused on taking action. Stay positive. Positive thoughts help make stress intermittent by focusing your brain's attention on something that is completely stress-free. You have to give your wandering brain a little help by consciously selecting something positive to think about. Any positive thought will lead you to focus your attention. Disconnect. I had to do this last night. I was getting calls from clients, and I had to, at about 4 o'clock, say, that's it. Not looking at that phone anymore. Not watching TV. Disconnect. Given the importance of keeping stress intermittent, it's easy to see how taking regular time off the grid can help you keep your stress under control. When you expose yourself to 24/7 barrage of information, it's inevitable you're not going to be able to control your stress. And finally, get some sleep. Can't say enough about the importance of sleep to increasing your emotional intelligence and managing your stress level. When you sleep, your brain literally recharges, shuffling through the day's memories and storing and discarding them so that you wake up alert and clear-headed. So with all those thoughts in mind, let's take a look at where we are this morning. And things are shifting minute by minute, so I need to give you a update here, which may not necessarily even apply in 20 minutes from now. But the Federal Reserve this morning took unprecedented action and pledged asset purchases with no limit to support markets. And this took us from last night being down limit on futures. I think when I got in this morning, we were down about 600 and then maybe 500 when I started preparing. And now, if you look at futures, and I'm specifically referring to the Dow, they're up about 250 points. And this is, of course, what we've experienced day after day, a bouncing ball. So anything goes a few minutes from now. But nevertheless, the Federal Reserve taking very drastic actions this morning, saying they will launch a barrage of programs aimed at helping markets function more efficiently in the wake of the coronavirus crisis. And I think this is critically important because the credit markets were acting inefficiently. The pipes were being backed up, and we needed the Fed to come in and help flush the credit markets, and the equity markets are not going to get better unless the credit markets are operating effectively. Among the initiatives is a commitment to continue its asset purchase program and the amounts needed to support smooth market functioning and effective transmission of monetary policy to broader financial conditions in the economy. What that means, we'll buy as many treasuries as needed. But they're not just buying treasuries. There will be a program worth $300 billion supporting the flow of credit to employers, consumers, and businesses, and 2 facilities set up to provide credit to large employers. The Fed is also going to purchase agency mortgage-backed securities as part of its expansion into asset purchases known as quantitative easing. The move represents an expansion into the commercial sector for real estate for the central bank's acquisition. One analyst said we are back into quantitative easing infinity. Fed is also going to be purchasing facilities. They're going to be activating facilities for the flow of credit to municipalities by expanding the municipal money market mutual fund liquidity facility to include a wide range of securities, including municipal variable rate demand notes and bank certificates of deposit. So hopefully these actions, in conjunction with the other news that's taken place this morning, which is the news that's coming out of the Senate, which is in session and currently trying to put together a stimulus package that will be somewhere in the neighborhood of $1.5 to $2 trillion. One of the big disappointments going into this morning was that that package had been delayed. Difference between Democrats and Republicans. This morning, Treasury Secretary Mnuchin on a Fox Business interview said he is hopeful that the Senate will pass the bill. There is a Senate procedure vote set for 9:45 Eastern Time. He also said he doesn't believe that the entire country should be shut down. He said that small businesses will be able to take out small business association loans that will be forgiven if employees are still on the payroll. All small businesses, he said, will have necessary liquidity. He wants the airlines to be able to operate. He said he does not believe this is a bailout. He said if the crisis lasts longer, the administration will request additional funding from Congress. All saying that on a recent interview. On Fox News, we got Steve Bannon saying that he agrees with Bill Ackman that President Trump should shut down the country. So you're going to get these cross currents and opinions going on. And again, most important thing, as I said before, is to remain calm as all these different factors swing into your thought process. To give you some ideas on some of the bond market this morning, which Brad will talk some more about, and I'm sure it's been a wild ride. The 30-year Treasury is down 21 basis points to 135. The 10-year is at a 175. The 3-month is barely positive. I think it might have been negative on Friday. 3 basis points on the 3-month, 31 basis points on the 2-year. Also important to keep an eye on currencies and take a look at the dollar versus currencies, because if the markets start getting concerned about the U.S. issuing lots of debt, the first place it'll show up is in the currency market. If the currency market is showing relative stability, then what the market's telling you is that they're okay with the U.S., at least at this time, issuing lots and lots of debt. And we are seeing the dollar remaining strong against most major currencies around the world. The dollar's at 107 versus the euro, so the euro is 107 to the dollar. The Japanese yen is at 110, and the pound is at 115. So dollar remaining strong, that is a positive sign, in my opinion, that the markets are giving a green light, at least at the moment, to issue more bonds. And we're getting some functioning in the metals market. We're seeing gold up $30 an ounce. Last week we saw gold cratering, even as we were talking about the massive potential for quantitative easing that we're seeing this morning and running up the debt. When you start seeing those sorts of actions, you would expect gold to appreciate. Yet it was depreciating, which indicates that people were selling anything that they could get their hands on in order to free up liquidity, in order to possibly meet margin calls or have enough cash on hand to live their life if they haven't been saving enough in savings accounts, and perhaps gold was feeling that selling pressure. This morning we're seeing gold up about 2%, we're seeing silver up about 4%, and we've seen oil recover this morning to about unchanged. Oil up a few cents this morning. Oil still very low at $22.67 an ounce. Other news this morning, we woke up and heard that President Trump activated the National Guard in 3 states. New York, California, and Washington State. We heard that Italy's death toll spiked to over 5,400. Germany's Chancellor Merkel has gone into quarantine after coming in contact with a doctor who tested positive for the virus. Talked that the Olympics very well may be delayed. And, in the good news and positive news segment, Cisco commits almost $250 million to assist in prevention of coronavirus. $225 million Cisco is setting aside for donations. 3M said it will supply New York and Seattle with 500,000 N95 respirator masks to address the shortfall. Merck said it's going to supply New York City with 500,000 masks. Chinese billionaire and Alibaba founder Jack Ma sent to Africa 5.4 million masks, 1 million test kits, 40,000 sets of protective clothing, 60,000 protective face shields, and BlackRock just announced that they're committing $50 million to assist in the outbreak efforts as well. Just to take a quick look back, last week was one of those weeks that I'm sure many of you will not forget. The S&P last week was down about 15%. The Dow was down about 17%. The NASDAQ was down 12%. Interesting, the U.S. Significantly down more than the rest of the world. Foreign stocks last week were down about 6%. Emerging markets down about 10%. Year-to-date numbers coming into today, S&P was down 28%, Dow down 32%, NASDAQ 23%. Year-to-date, the 10-year Treasury prior to this morning was up 8.3%, and I'm sure something Brad will talk some more about in a few minutes. Munis down 7% year-to-date going into today. A couple of stories in Barron's, couple of sectors to take a look at. I'm going to talk about the three different sectors, all of which may be somewhat defensive. At least two of the three certainly could be classified that way. Utilities slid last week. Barron's saying that they still offer a defensive dividend haven. The utility ETF XLU last week was down about 17%. That's trailing the S&P, which I just mentioned was down 12 to 13%. So utility selling off more than the overall markets last week. Analyst who covers utilities and energy firms attributes the sector sell-off to indiscriminate selling of equities and turning to cash and cash equivalents, sort of what I was citing earlier, selling things that had held up best in order to get cash at any cost. Perhaps throwing the baby out with the bathwater here in the utility sector. Barron suggests taking a look at, or at least this analyst in Barron suggests taking a look at three of the strongest utilities. Next era, symbol NEE, which is yielding about 2.8%. Dominion Energy, which is yielding about 5.8%, and Duke Energy, which is yielding about 5.5%. Analyst goes on to say that the sell-off notwithstanding, the sector will serve its traditional role during the coronavirus-driven tumult, where they continue to see the U.S. utility sector as being highly defensive. Article points out that dividend utilities, with some of these yields north of 5%, some of them are over 400 or 500 basis points over Treasury yields, and that's 10-year Treasury yields, historically a very wide margin. Of course, there is some concern that during this crisis, commercial electric usage is likely to be weak, and the analysts feel that is manageable and a temporary effect of the sector. And some of that weakness will be offset by strength in the homes, as people are home cooking more, watching more television, using their home computers instead of their office computers. So it's not a complete negative. It's a negative offset by a positive, although not as much of a positive as the negative. As for regulated utilities, analysts feel that by and large those dividends at this time remain safe to be able to keep paying those yields. Another sector that has come under tremendous pressure are REITs, real estate investment trusts, especially ones that have retail properties in them. And Barron's saying that as REIT shares have plunged, there are four REITs where insiders have been meaningfully buying stocks. And this is Simon Property Group, symbol SPG, the mall operator. Stocks down 68%. Gaming and leisure properties, symbol GLPI, down 56%. Boston Properties, BXP, down 41%. And Macerich Properties, symbol MAC, which is down 73%. By comparison, S&P in that same time period is down about 30%. Simon Properties did announce on March 18th closing of all of its domestic properties, including upscale malls and premium outlets. That day, the stock did tumble 24%. The day before that announcement, David Simon, the company's chairman, CEO, and president, paid $9 million for 150,000 shares at about $60 per share. Stock's trading in the 40s right now. He now owns just under 1 million shares in his personal account, according to a recent SEC filing. He has not made a stock purchase since 2004. His uncle and chairman emeritus also bought about $10 million in stock on March 18th. In the gaming and leisure space, I mentioned the stock GLPI. Insider Peter Carlino bought about $2 million of stock between March 13th and March 16th. Also in that same gaming and leisure space, Penn Gaming, symbol PENN, saw significant insider purchases. I mentioned also Boston Properties directors and insiders purchased about $1 million of stock between March 9th and March 11th. And at Macerich, we see the CEO paid $250,000 for 25,000 shares, and he paid $9.95 for the stock that he purchased. Another sector spoken positively about in Barron's is, and I just want to give you some news here, that the Treasury Secretary Mnuchin says Congress is very close to a stimulus agreement and must get it done today. His latest comments: futures now on the Dow up about 400, the S&P up 50, the Nasdaq up 182. 10-year Treasuries hovering at about 80 basis points. I think it was 79 earlier. Anyway, back to the other article. Other sector being spoken favorably of are big banks, which are facing their first major test since the financial crisis. And Barron's points out that the only sector that has been stress tested for an environment like this are the banks. And the Fed puts the banks through an annual stress test, including a severe one that includes an 8% drop in GDP, a 10% unemployment rate, and a 50% drop in the stock market. And the banks emerged intact from this model with ample capital, and that's after returning cash to shareholders and being able to pay dividends, and even including their stock buybacks, which may or may not continue. So the banking group is the only group out there that has actually been tested and has policies and contingencies in place for a situation like this, and that's the result of the 2008 crisis. Perhaps after this crisis, we may see different contingencies put in place for the travel industry or other industries if they receive federal funding. Ken Langone on CNBC this morning, when discussing what the long-term effects of the corona outbreak will be, and he was extraordinarily positive on America and extraordinarily positive gotten through this. But he pointed out after 9/11, when now you go into an office building in New York and you go to a high-rise, it's routine. You give your ID and you get background checks in some buildings before you can go up. He points out that there may be ongoing changes to how the government and how we live our lives, what we keep in our homes after this pandemic. But nevertheless, the banks have been stress tested. And Barron's talks about 6 banks in particular: Bank of America, Citigroup, Goldman Sachs, J.P. Morgan, Morgan Stanley, and Wells Fargo. And they had a conversation with Mike Mayo, well-known banking analyst, and he acknowledges that plenty of risk remains. Nevertheless, he says the bank stocks look appealing. He says you have to take a look, not necessarily at what earnings are going to look like going forward, but take a look at book value. J.P. Morgan's at 1.4 times book value. Bank of America at 1.1. Goldman Sachs is at 70% of book value. Citibank is at 55% of book value. He said it's night and day how the banks look versus the financial crisis. Bank balance sheets were weak and now they're strong. And he says the degree of resiliency is underappreciated. He said that he would be shocked if one of the top 10 banks needed to raise equity or cut its dividend. Mike Mayo favors J.P. Morgan, Bank of America, U.S. Bancorp, and PNC, the latter two being amongst the highest quality regional banks. He does point out that Goldman Sachs and Morgan Stanley have less lending exposure than their peers because they have less traditional banking in their portfolios. He also goes on to discuss that another sector in the banking sector that looks appealing are the bank preferred shares. Something like PFF, which is a ETF, the iShares Preferred Income and Securities Exchange Traded Fund, which owns banking preferred stocks. As of Friday, that was yielding about 7%. He also addressed some of the concerns with regards to loans. J.P. Morgan has $188 billion of tangible equity, but they have $2.6 trillion in assets, but they only have about $948 billion in loans. Of those loans, when you take a look at the large banks, one of the big worries is exposure to energy. And he points out that of the large banks, their energy exposure ranges from about $13.5 billion to $20 billion, which accounts for anywhere between 1 to 3% of their loans and accounts for anywhere between 6 and 11% of their equities. He doesn't expect those loans to go to zero in most cases because banks tend to have the most senior obligations of the energy companies. often having collateralized loans, at least for some of the amounts that they've lent to these companies. That's everything I've got for this morning. Certainly a busy morning. Certainly going to be a busy week. Going to turn it over to Brad, talk some more about the bond market and the financial markets, and get his wisdom and some comments. Good morning, Brad.
Morning, Keith. Thank you. Morning, everyone. I know it was probably one of everyone's worst weeks ever, and tough weekend, sleepless nights, and we're all in this together. We really are all in this together. Just want to say, last week I said, before you can handle anyone else, you need to be in your own good mental state, take care of yourself and your loved ones. Don't worry about, my opinion is, don't worry about missing the bottom of the market. If there is a bottom of the market, let the algos worry about that. Trading emotionally can be a big curse. So you have to be thoughtful, and you have to move at your own pace. And I don't think that we're going to have some sort of crazy bounce back overnight. We might one day, but this is not going away quickly. Institutional traders and buyers are going to be work from home, so the markets are going to be thin. They're going to be moving slowly, with the exception of the computerized trading. And as far as my part of the world, municipals are concerned, I speak to Keith Douglas all the time about the munis and what's going on and what looks crazy and what looks great, but it's still trying to figure itself out. For a long time, we had said, look at the higher coupon bonds, gives you a little bit of protection down market. Had no idea that the down market in municipals was going to come like this. But you never know where it's going to come from, and that's why you want to have some protection. Some of these 2% coupons are now trading in the 80s. Some of the 3% coupons are trading in the low mid-90s. And on the very long end, you can pick up some 4s at par. There are two ways to look at opportunities in the municipal market. You can have a little time to do this. You don't have to do it today, because, like I said, people who work from home, this market is not going to run away from you. For real income investors that are in this for the long haul and new money, then maybe look at one of these long bond 4 at par, or even a 5 at a slight premium with decent call protection, not a short call. You don't want to get called out. If you're looking to get some of this, if you're trying to make some money back for some of the downside, I would recommend going with the discount 3s, that you'll be able to find in the low 90s, low mid-90s. And I don't even know where we're going there for certain, but at the moment it looks like low mid-90s are what the 3s are. And when the markets normalize, if the bailout happens for municipals, which I assume it's going to, then those bonds will trade back to par, and we'll get back into more normalized yield curve. The other thing that I've talked about for a long time since I've been with the firm is always keep an eye on your credit. Credit is of great importance, and we're really going to see here who the survivors are going to be in the municipal bond market. There's a lot of pressure on transportation bonds, obviously, as there is in the equity market also. So MTA is under a lot of pressure. New Jersey transportation is under a lot of pressure. The airports, I'm sure that they're all going to get federal funding, but we have to see where they ultimately play out. I would not necessarily look for those bonds at this period. I have, just to give you a heads up of what has happened in the municipal bond market, I've reset my searches from a 1.25 yield to a 2.25 yield minimum to the types of bonds that I look at, and I think that like everything else, it's going to be a great buying opportunity to decide what their proper allocations want to be, because in the municipal market, if it works out, you could wind up having some equity-like return in some of these deeper discounts. That looks interesting, and we'll also try to the best of our ability to keep an eye on these credits and what's going on with certain federal funding, and I will be keeping my ear to the market, as I know Keith will be also, looking for reports and seeing what the so-called experts are claiming are the bonds to buy. In 2008, they kept saying essential revenues, like New York City municipal water, for instance. So I don't know if it'll be the same this time, or if they're going to say go with the taxing power of the general obligation. So we're not quite there yet to see what the experts are going to say, but we will certainly keep you abreast of all information that comes in. And good luck, and stay healthy. It's the most important thing. And thank you.
Thank you, Brad. That's everything I've got.
Thank you for listening to Mr. Keith Lanton. For more podcasts, please visit our website, www.lanternwa.com.